In every market, behind every chart and candlestick, there's a heartbeat, the rhythm of human emotion. Prices don't rise and fall just because of earnings, data, or charts. They move because people react to hope, fear, greed, and regret. This is the essence of behavioral finance, the study of how our psychology shapes the market itself. When traders chase rising prices, they're not following strategy, they're following emotion. When they panic during a drop, they're surrendering to fear, not analysis. The crowd buys the top and sells the bottom because it listens to its feelings louder than its reason. But those who understand this psychology, who see beyond the noise, know that markets reward the calm observer, not the emotional participant. They wait while others rush. They plan while others panic. They understand that accumulation happens quietly, in patience, while the world looks away. The market is a mirror. It shows you not just price action, but your own reflection, your impatience, your excitement, your fear. Master that reflection, and you master the market. Because in the end, trading isn't about predicting what others will do. It's about predicting what you will feel and learning how to control it. The true trader doesn't fight the crowd. He outthinks it, outweights it, and eventually outgrows it. Control your emotions, and the market will reveal its rhythm to you. Lose control, and it will teach you the same lesson again and again until you finally listen. The stock market is often described as a living organism constantly breathing, reacting, and adapting. But what truly fuels its movement isn't merely news or numbers. It's the collective pulse of human emotion. Every rise and fall, every surge and collapse, is a mirror reflecting what people feel rather than what they know. Prices are the visible footprints of invisible psychology, the hopes, fears, and instincts of millions interacting at once. When prices climb, optimism spreads like wildfire. Traders feel confident. Their screens glow green, and suddenly logic fades. They believe the trend will never end. Fear of missing out becomes stronger than discipline. Volume surges not because new information appears, but because emotion demands participation. The crowd feels safety in numbers, unaware that euphoria itself is the warning signal of exhaustion. The higher the excitement, the closer the turning point. Then comes the opposite swing. A sharp drop, a red candle, and suddenly the same crowd that once shouted buy now whispers sell. Panic replaces confidence. What was once seen as opportunity now looks like danger. Prices collapse, not because the company's value changed overnight, but because collective fear did. This emotional pendulum between greed and fear keeps the market alive, but also keeps the unprepared trapped in endless cycles of reaction. The smart observer understands that emotion is not an enemy, it is data. Each surge in optimism or panic reveals imbalance. The market's task is to restore equilibrium, and it does so by punishing emotional extremes. When too many feel one way, the opposite direction becomes inevitable. This is why charts seem to trick traders. They are not tricking anyone. They are simply exposing emotional bias in real time. Understanding this truth turns charts into psychological maps. Candlesticks are not just bars of price. They are records of collective decisions made under emotional pressure. Every breakout is a burst of greed. Every sharp sell-off is a wave of fear. A trader who reads these movements is, in fact, reading human nature itself. It is no coincidence that the same behavioral patterns repeat across decades, markets, and asset classes, because human emotion has never changed. The untrained mind sees chaos. The disciplined mind sees rhythm. The market breathes in waves because emotions do. Each phase of excitement and despair feeds the next. The observer who studies these emotional tides learns to anticipate crowd behavior long before it becomes visible in price. While the masses react impulsively, the calm observer watches for signs of exhaustion, the point where emotion burns out and opportunity is born. This understanding transforms trading from prediction into observation. It removes the illusion of randomness and reveals the market for what it truly is, a perfectly imperfect reflection of the human psyche in motion. The market is a theater of collective behavior, a vast arena where millions of minds act in unison, often without realizing it. Every decision, every order, every click to buy or sell is part of a greater pattern that reflects the psychology of the crowd. While each trader believes they are acting independently, the truth is that most are guided by the same emotional undercurrents, responding to the same stimuli, and seeking comfort in the same direction as everyone else. Crowd behavior is rooted in human survival instinct. In ancient times, following the group meant safety. In modern markets, it often means disaster. When prices rise, the crowd rushes in. When prices fall, the same crowd runs out. What once was a useful instinct for survival becomes a mechanism for loss. The crowd does not analyze, it reacts. It does not prepare, it responds. And its strength lies not in intelligence but in emotional volume. When enough people feel the same way, their collective actions move prices, forming trends that seem logical but are born purely of shared emotion. This behavior can be seen in every chart and every bubble in financial history. The internet boom, the housing market surge, the crypto rallies all follow the same path. A small group begins to accumulate quietly, while the majority remain unaware. As prices rise, excitement builds, and the crowd joins in, convinced it has discovered something new. The more the price increases, the more confident they become. The crowd feeds itself with emotion, transforming optimism into mania. Eventually, when enthusiasm reaches its peak, there are no buyers left, only believers. The trend reverses, and the same collective energy that fueled the rise now accelerates the fall. The tragedy of the crowd is that it cannot see itself. Each participant believes they are making rational choices, yet they move in perfect synchronization with thousands of others making the same rational decisions. The power of confirmation blinds them to risk. They seek information that supports their emotions and ignore signals that challenge their comfort. In this way, the crowd builds its own illusions of safety, of opportunity, of control. To watch the crowd is to understand the rhythm of mass psychology. It acts with predictable impulsiveness, buying strength, selling weakness, fearing uncertainty, chasing clarity. The collective mood can shift in seconds, yet its essence never changes. Traders who learn to observe this behavior rather than join it begin to see where the majority will act before they act. They see how the emotional weight of the crowd pushes prices beyond logic, creating imbalance, and how that imbalance must eventually correct itself. The crowd dominates the market not because it is right, but because it is large. Its movement defines the surface of price, yet its understanding remains shallow. The deeper currents belong to those who can recognize the crowd's patterns, those who study its habits, anticipate its reactions, and refuse to think or act as it does. In every market cycle, there exists a quiet contrast between those who follow and those who lead. Most participants are guided by emotion, reacting to every flicker of price and every headline that crosses their screens. Yet within the noise, there is a smaller, disciplined group that observes, plans, and acts with precision. These individuals do not trade on excitement or fear. They trade on understanding. They see the crowd not as competition, but as a predictable force to be studied and used to their advantage. The difference between ordinary traders and those who think differently lies not in the tools they use, but in the perspective they hold. The masses focus on the present moment, the price that moves now, the candle that forms today, the news that breaks this hour. The patient and perceptive, however, look beyond the immediate. They watch how emotion builds, how volume shifts, how the crowd's behavior sets the stage for opportunity. While others chase what has already moved, they prepare for what must inevitably happen next. When fear dominates, they begin to look for strength. When euphoria blinds the market, they quietly take the opposite side. Their advantage is not timing born of luck, but timing born of observation. They recognize that markets are structured on imbalance, too much optimism or too much despair, and those extremes are the points of greatest profit. They wait for confirmation not from indicators, but from behavior itself. Every sudden surge of participation, every emotional breakout, is a signal that the crowd has become vulnerable. Thinking differently requires detachment. It demands the ability to separate personal feeling from market movement. Where the average trader sees opportunity and momentum, the calm observer sees exhaustion. Where the crowd sees danger in a decline, the discerning mind sees value forming quietly beneath panic. The market speaks in contradictions, and only those who are patient enough to listen without reacting can interpret its true language. This mindset is not built on prediction, but on preparation. It does not seek to know what will happen, but to understand how others will respond when it does. The thoughtful trader does not fight against the crowd's emotions. He anticipates them. He knows that when the masses are most convinced of direction, the market is closest to reversal. He studies patterns not to copy them, but to recognize when emotion reaches its limit. To think differently in trading is to see emotion as structure and psychology as data. It is to view the market not as a mystery to be solved, but as a system driven by predictable human impulses. The mind that can detach from the noise, that can observe without the need to participate, begins to sense opportunity before it becomes visible to the majority. It is through this quiet understanding that true market wisdom begins to take form. In trading, movement attracts attention, but stillness creates mastery. The market rewards not those who act the fastest, but those who wait the longest with clarity and purpose. Patience is not the absence of activity. It is the discipline to act only when the odds align, when emotion cools, and when opportunity is real rather than imagined. Most traders lose not because they lack knowledge, but because they cannot wait. They mistake motion for progress, believing that every tick requires a response, every fluctuation demands involvement. Yet the greatest profits are often earned in the quiet moments between decisions, when one chooses to do nothing at all. Patience is the rarest quality in an environment designed to provoke reaction. Charts flash, notifications buzz, opinions flood every screen, all built to stir urgency. The crowd moves as if delay is defeat. But the market, by nature, moves in cycles: expansion, contraction, accumulation, distribution. To capture the essence of those cycles, one must think in seasons, not seconds. The wise trader studies the build-up, the preparation phase, when price appears dull and emotion is low. It is in these moments that future trends are born, when the impatient leave and the patient observe. Every major move begins long before it becomes obvious. While the crowd waits for confirmation through price explosion, the patient mind has already positioned quietly during silence. Patience allows one to see what others overlook: the subtle shifts in volume, the faint signs of absorption, the exhaustion of selling pressure. It transforms the trader from a participant in chaos to an observer of structure. In the waiting, understanding deepens. In the stillness, clarity sharpens. Impatience, on the other hand, is the fuel of losses. The desire for instant validation leads to overtrading, chasing entries, exiting too soon, and re-entering too late. The mind that cannot wait becomes a victim of its own impulses, reacting not to the market's logic but to its emotional triggers. Patience is not merely a virtue, it is a shield against self-destruction. It separates thought from impulse, giving space for reason to breathe. In market psychology, patience has a paradoxical quality. It feels unproductive, yet it is the foundation of every decisive move. Those who wait correctly are not idle. They are observing, calculating, and aligning themselves with the deeper rhythm of price behavior. They understand that markets move to shake out those who cannot remain still. The noise of volatility is designed to test conviction. Only the patient survive these tests, not through resistance, but through observation and restraint. The power of patience lies in understanding that opportunity cannot be forced. It must mature. Like a seed beneath the soil, it develops unseen, demanding trust in timing and faith in preparation. The mind that rushes interrupts this natural process, but the one that waits learns to act when the moment is ripe, and the crowd remains distracted by its own urgency. In the world of trading, charts, tools, and indicators are often seen as the path to mastery, but they are only fragments of a larger truth. Every line drawn, every setup identified, and every analysis performed is filtered through the trader's state of mind. Without emotional control, even the most precise technical skill becomes fragile. The market does not reward intelligence alone. It rewards composure under uncertainty. Knowledge helps one see opportunity, but emotional balance determines whether that opportunity is captured or destroyed. Every trader begins with analysis, but few remain consistent because they cannot manage themselves when real money is at risk. Fear clouds logic, greed distorts judgment, and impatience turns strategy into chaos. The mind that panics after a small loss or becomes euphoric after a small win begins to drift away from discipline. The technical system may be flawless, yet its execution collapses under the weight of uncontrolled emotion. The market's greatest challenge is not the unpredictability of price, but the unpredictability of one's own reaction to it. Emotional control is the invisible structure that supports every successful trade. It allows the trader to remain objective when the crowd loses balance. A disciplined mind can watch price fluctuate violently and still act according to plan. It does not celebrate prematurely nor despair unnecessarily. This balance creates consistency, the rarest and most valuable skill in any market. The undisciplined trader, however, turns every move into a test of identity, feeling validated by wins and wounded by losses. The moment emotion becomes personal, decision-making becomes corrupted. Control begins with awareness. The trader who understands his psychological triggers gains an edge far beyond technical analysis. Each loss, instead of being punishment, becomes information. Each win, instead of feeding ego, becomes confirmation of process. The ability to detach from outcome is what separates mastery from mediocrity. Emotional control does not remove feeling, it regulates it. It transforms reaction into response, panic into patience, and greed into gratitude for discipline. In moments of volatility, emotional control acts as an anchor. When prices surge, it prevents reckless chasing. When prices collapse, it prevents surrender. It keeps the trader aligned with the strategy rather than swayed by the crowd. This calm state of mind allows one to see opportunities that panic hides. Technical skill may identify a level of support, but emotional balance determines whether one waits for confirmation or jumps impulsively into risk. The truth is that the market feeds on emotion. Every exaggerated move, every false breakout, every violent reversal is designed to test emotional boundaries. The trader who cannot regulate himself becomes part of that fuel, yet the one who maintains calm turns chaos into clarity. Mastery of self transforms uncertainty into advantage, proving that while technical skill builds a framework, it is emotional discipline that breathes life into it. In trading, profit is never the first stage of success. It is the outcome of preparation that often goes unseen. Many enter the markets with the desire to earn quickly, believing that money can be made through a few indicators or a handful of lucky trades. Yet the foundation of lasting success is built not on immediate reward, but on deep understanding, gathered through time, study, and observation. The accumulation of knowledge is the invisible phase that precedes every visible result, just as the quiet accumulation phase in the market precedes every powerful trend. Knowledge in trading is not limited to strategies or chart patterns. It is the gradual awareness of how the market breathes and how the trader's own mind reacts within it. Each phase of learning reveals more about human behavior than about price itself. To accumulate knowledge is to watch without the urgency to act, to observe the rhythm of supply and demand until it becomes instinctive. It requires patience, humility, and the ability to accept that real growth occurs during stillness, not during excitement. Most traders skip this stage. They rush toward profit without first earning understanding. They memorize setups but never study their context, imitate signals but never grasp the psychology behind them. In doing so, they trade without structure, unaware that the market will extract from them the tuition they refuse to pay in time and effort. Knowledge accumulation is the unseen apprenticeship of every skilled trader, the hours spent reviewing charts, studying volume, journaling emotions, and reflecting on mistakes. Each repetition sharpens perception, turning confusion into clarity. The true value of knowledge lies in its ability to transform instinct. When a trader has studied deeply enough, hesitation fades because understanding replaces hope. The market no longer appears random but becomes a landscape of behavior, a sequence of emotional reactions that can be anticipated. This transformation cannot be taught through shortcuts. It must be earned through repetition and observation. The quiet periods of learning are where the mind begins to align with the natural rhythm of price, where logic begins to overpower emotion. Just as professional investors accumulate positions while the crowd remains distracted, the disciplined learner accumulates insight while others chase profit. This knowledge compounds invisibly, forming a mental capital more powerful than money itself. Each lesson becomes stored awareness, each mistake an added layer of wisdom. When the moment finally comes to act, decisions flow with calm precision because the groundwork has been laid. The trader no longer guesses, he recognizes. The market no longer intimidates, it communicates. Profit is the reflection of this invisible process. It does not appear as an isolated event, but as the natural byproduct of accumulated understanding. The longer one invests in study, the more natural execution becomes. The focus shifts from making money to mastering the process, and through mastery, profit arrives not as luck, but as the quiet confirmation of knowledge well earned. In trading, desire is the spark that begins the journey, but discipline is the force that sustains it. Every trader enters the market with dreams of freedom, wealth, and mastery, yet those dreams often fade under the weight of impulsive decisions. The market does not reward those who want the most. It rewards those who can control what they want. Discipline is the boundary that keeps desire from turning into destruction. It transforms emotional ambition into structured action, replacing the chaos of impulse with the calm of consistency. Desire seeks immediate gratification. It wants results now: a quick win, a lucky streak, a sudden confirmation of skill. Discipline, however, understands that trading is a process measured in probabilities, not promises. It demands routine, patience, and repetition. The disciplined trader follows a plan even when it feels uncomfortable, trusting in preparation rather than emotion. While desire burns hot and fades quickly, discipline is the steady flame that endures through uncertainty. It is the quiet voice that says, "Wait," when excitement shouts, "Act." Every loss in the market is not purely technical. It often begins as a lapse in discipline. Breaking rules, moving stop losses, chasing entries, or ignoring risk limits are all symptoms of unchecked desire. The urge to make more, to recover faster, to prove oneself right overrides logic and turns strategy into improvisation. The disciplined mind understands that every rule has a purpose, not to restrict, but to protect. Boundaries in trading are like guardrails on a mountain road, unnecessary when the path is smooth, essential when it becomes dangerous. Discipline is built in repetition. It is not a single act of restraint, but a habit forged through consistency. Each time a trader chooses to follow the plan over emotion, that mental muscle strengthens. Over time, following structure becomes natural, and temptation loses its hold. The disciplined trader does not avoid emotion but learns to act despite it. He recognizes fear and greed, but does not surrender to them. He knows that success is measured not by how much he wins, but by how well he adheres to process. Desire focuses on outcome. Discipline focuses on behavior. The first is reactive, the second intentional. The market constantly tempts traders to abandon structure. A sudden rally invites greed. A quick drop provokes fear. Social media amplifies noise, yet discipline stands unmoved. It is the bridge between analysis and execution, between knowledge and application. Without it, even the most intelligent strategy collapses under pressure. Discipline gives form to patience, purpose to risk, and structure to confidence. It is the invisible framework that holds consistency together, guiding decisions when emotion clouds judgment. The market tests discipline every day, whispering promises of easy gain and quick recovery. But only those who remain steadfast through both euphoria and despair preserve their capital, their mindset, and their place within the rhythm of the market. Every trader enters the market, believing the challenge lies in price movement. But the true test begins within. Before the market takes capital, it tests conviction. Before it inflicts financial loss, it exposes psychological weakness. The market's movements are neutral, yet the trader's reactions to them reveal everything about their emotional structure: patience, fear, greed, overconfidence, and doubt. Each fluctuation becomes a mirror reflecting internal balance or imbalance. It is not the chart that creates difficulty. It is the mind's response to uncertainty that defines success or failure. The first test is emotional stability. When trades move against expectation, anxiety begins to rise. The inexperienced trader views this discomfort as something to escape rather than something to understand. The impulse to close early, to reverse positions, or to overtrade emerges from the inability to sit calmly with uncertainty. The market uses this discomfort as a filter, separating those who react impulsively from those who observe patiently. Emotional control becomes the first defense. The ability to remain still when the environment provokes action. The second test is mental endurance. A series of losses, missed opportunities, or stagnant conditions erodes confidence. The market often pauses, retraces, and misleads, forcing the trader to question their methods and self-belief. It asks silently whether the trader can continue to follow their plan without the comfort of immediate validation. Many fail here, abandoning discipline for excitement, seeking certainty in a place built on uncertainty. Yet those who understand the nature of the test recognize that patience through discomfort is the price of clarity. The third test is consistency under pressure. Success can be more dangerous than loss, for profit often awakens hidden emotions, greed, arrogance, and illusion of control. After a winning streak, traders begin to feel invincible. They increase size, ignore limits, and trade outside of plan. The market observes this change and responds with volatility that breaks confidence once more. Every rise in emotion invites an equal and opposite correction, not from price, but from psychology itself. The market tests through deception, false breakouts, sudden reversals, unpredictable timing. Each pattern is not merely a technical movement, but a psychological challenge designed to measure composure. It rewards the few who maintain focus when chaos surrounds them. It punishes those who trade emotion rather than structure. The purpose of these tests is not to defeat, but to refine. To reveal whether one's mindset aligns with the natural rhythm of uncertainty that governs all markets. Every trade becomes a question. Can you remain objective when the outcome is unknown? Can you follow logic when emotion demands reaction? The market's first lesson is never financial. It is emotional. Before it challenges strategy, it challenges self-control. The trader who passes these invisible tests proves not mastery over price, but mastery over reaction, and that mastery becomes the foundation for every decision that follows.